Here is the most important economic number most Canadians have never heard. If Canada had simply matched U.S. productivity growth since the year 2000, the average Canadian would have approximately $15,000 more in annual income today. Not because of better luck, not because of a different job, not because of any individual decision, because the economy would be generating more output per hour of work, and workers would be sharing in that output through higher wages. Instead, Canada's GDP per capita has fallen from approximately 80% of the U.S. figure in 2002 to approximately 67% in 2024. Canada now ranks 38th in the world in GDP per capita, while the United States ranks 8th, and the OECD, the organization that tracks economic performance across 38 wealthy nations, projects that Canada will rank dead last among all 38 OECD members in GDP per capita growth through the year 2060. Dead last. Not declining slightly, dead last. Most Canadians feel this without being able to name it. The sense that you are working just as hard, but getting further behind. That houses cost more. Groceries cost more. Everything costs more. But the paycheck does not keep pace. That friends who move to the U.S. are visibly more financially comfortable despite doing the same work. This feeling is not a perception problem. It is a productivity problem. And this video explains exactly what it is, why it is happening, and what it means for every Canadian investor. Productivity is one of those economic terms that sounds abstract until you understand what it actually measures. And then it becomes the most important number in the economy. The simple definition, labor productivity, measures how much economic output is produced per hour of work. If a Canadian worker produces $50 of GDP per hour of work, and the productivity grows by 2%, next year they produce $51 per hour. That additional $1 per hour worked across the entire economy is how living standards improve over time. Wages rise, tax revenues rise, public services improve. The entire economy gets richer without anyone working harder. They just work more efficiently. Why productivity is the root of everything. Every sustainable improvement in living standards comes from productivity growth. Not from working more hours, that path has a ceiling. Not from immigration. Adding workers adds to both the numerator and the denominator of GDP per capita. Not from government spending. Government spending redistributes existing wealth. It does not create new wealth. Productivity growth is the only mechanism by which an economy becomes durably richer per person over time. When productivity grows, workers can be paid more without causing inflation, because the additional output justifies the additional wage. When productivity stagnates, wage increases become inflationary, employers resist them, and real wages go nowhere. The connection is direct and unavoidable. Canada's specific numbers. Between 2018 and 2023, Canadian business productivity declined by 0.6%. In the same period, the United States experienced a 10.1% increase. Between 2019 and 2023, Canadian labor productivity growth averaged essentially 0 per year. The U.S. averaged 1.5% annually over the same period. Over the entire period from 1981 to 2024, U.S. labor productivity increased by approximately 127%. Canada's increased by approximately 61%. These are not small differences. Over decades, the compounding of a 1% to 2% annual productivity gap produces vastly different economies. A worker in a 1% more productive economy earns 22% more after 20 years than a worker in a stagnant economy. 2 decades of the productivity gap is approximately $15,000 per Canadian per year. The number, from the hook. Here is the vault, the specific mechanism by which low national productivity directly reduces your individual take-home pay, and why it compounds against you the same way interest compounds for you in an investment. The transmission mechanism, how productivity affects your paycheck. Step 1. Low productivity means low output per hour. When Canadian workers produce less per hour than American workers, Canadian businesses generate less revenue per employee. Less revenue per employee means less money available to pay wages above the cost of operating the business. Step 2. Low output constrains wage growth. In a high-productivity economy, employers can afford to raise wages because each worker is generating more output. More products sold, more service delivered, more value created. In a low-productivity economy, raising wages without corresponding productivity growth causes inflation, because more money is chasing the same amount of output. The Bank of Canada then raises interest rates to contain the inflation, making mortgages more expensive, consumer credit more expensive, and slowing the economy further. Step 3. Low productivity depresses the currency over time. An economy that produces less value per hour worked than its trading partners experiences downward pressure on its currency, because its exports are worth less relative to imports. The Canadian dollar at approximately 72 cents to 74 cents USD in 2026 reflects in part the accumulated productivity disadvantage relative to the U.S. Every imported good, food, cars, electronics, clothing, costs more in Canadian dollars than it would in an economy with a stronger currency. Step 4. The compounding effect. Year 1 of low productivity produces a small wage gap. Year 5 produces a medium gap. Year 20 produces the $15,000 gap. The mechanism is identical to compound interest, except it is working against you rather than for you. Every year Canada fails to close the productivity gap is another year of compounding at the wrong rate. The specific personal cost to you, at a Canadian median household income of approximately $70,000 after tax. The $15,000 productivity gap represents approximately 21% of your take-home income. Money you would have earned if the economy had been growing at the same productivity rate as the U.S. over the past 2 decades. Money that instead represents a permanent reduction in your living standard relative to where it should be. The productivity crisis has 5 specific structural causes, each documented, each fixable in theory, and each deeply entrenched in Canadian political and economic reality. Cause 1. Chronic underinvestment in business capital. Investment drives approximately 80% of productivity growth. When businesses invest in new machinery, technology, software, and equipment, workers become more productive because they have better tools. Canadian business investment has been dramatically below peer nations for a decade. In 2025, Canadian workers received only 55 cents of new capital investment for every dollar received by their U.S. counterparts. Canadian non-residential business investment per capita sat approximately 9% below its pre-COVID baseline in 2024, meaning businesses are investing less in tools per worker than before the pandemic. You cannot produce more output per hour if you have fewer and worse tools. Cause 2. Interprovincial trade barriers. Canada has more internal trade barriers between provinces than many countries have with foreign nations. A construction worker licensed in Ontario cannot freely work in Alberta. A professional credential recognized in Quebec may require re-examination in BC. Food products that meet federal standards may still face provincial restrictions. These barriers fragment the Canadian internal market, preventing businesses from scaling, reducing competition, and suppressing the efficiency gains that come from a truly unified national economy. Estimates of the cost of these barriers range from $130 to $200 billion annually. Cause 3. Low business innovation and R&D investment. Canada significantly underinvests in research and development relative to peer nations. Business expenditure on R&D as a percentage of GDP is consistently below the OECD average. Canada produces world-class research at its universities and then watches U.S. companies commercialize it. The venture capital ecosystem to scale Canadian innovation is underdeveloped compared to the U.S. Promising Canadian companies are acquired by U.S. buyers or relocate south to access U.S. capital markets, taking the productivity-enhancing innovation with them. Cause 4. The brain drain. Canada is exporting its most productive workers. A Canadian engineer, software developer, or specialist physician who moves to the U.S. takes their human capital, their skills, their innovation potential, their tax contributions, with them. And they have an overwhelming financial incentive to do so. A Canadian software engineer earning $120,000 in Toronto might earn $200,000 to $250,000 in Seattle. With lower U.S. federal tax rates and dramatically lower housing costs in many U.S. cities. Canada's top marginal combined federal-provincial rate reaches 53.53% in Ontario. The U.S. federal top rate is 37%. The tax differential at high incomes is a powerful incentive to leave. Cause 5. Concentration in lower productivity sectors. Canada's economy is heavily weighted toward sectors with structurally lower productivity growth: real estate, financial services in retail banking, natural resources extraction, and construction. These sectors employ millions of Canadians, but do not generate the productivity gains that technology, advanced manufacturing, and knowledge industries do. The U.S. economy is increasingly concentrated in technology, the highest productivity growth sector in the modern economy. Canada does not have a domestic technology sector at comparable scale, and its TSX index reflects this concentration in lower productivity industries. The productivity crisis is not just a macroeconomic story. It has direct, specific implications for Canadian investors, and understanding them changes how a Canadian should structure their portfolio. Implication 1. The TSX will likely continue to underperform the S&P 500. The TSX's sector composition, 30% financials, 20% energy, 13% materials, reflects the structure of the Canadian economy. These sectors have structurally lower productivity growth than technology. The S&P 500's approximately 30% technology weighting gives it direct exposure to the sector generating the most productivity gains and therefore the most earnings growth. Over the past decade, this difference produced approximately a 4 to 5% annual return advantage for the S&P 500 over the TSX in Canadian dollar terms. If the structural productivity gap persists, which the OECD projects through 2060, so does the return gap. This is the most important investment implication of the productivity crisis. A Canadian who holds only Canadian equities is holding a concentrated bet on the lower productivity side of the Canada-US economic divergence. Implication 2. The Canadian dollar is likely to remain under long-term pressure. Currencies follow productivity over the long run. An economy that consistently produces less output per hour than its major trading partner experiences persistent downward pressure on its exchange rate. The Canadian dollar's long-term trend from parity in 2011 to 2012 to 0.72 to 0.74 US dollars in 2026 is not random. It reflects accumulated productivity underperformance. If Canada's productivity gap does not close, the CAD likely faces continued long-term depreciation pressure relative to the USD. For a Canadian investor holding U.S. equities, CAD depreciation is a tailwind. Every year the loonie weakens, U.S. dollar-denominated investments are worth more in Canadian dollars. This is the currency argument for maintaining significant U.S. equity exposure in a Canadian portfolio. Implication 3. Canadian wage growth will remain constrained. Wages cannot durably grow faster than productivity. If Canadian productivity growth remains near zero, real wage growth will remain near zero. This has direct implications for every Canadian household's ability to save, invest, and build wealth. It reinforces the case for maximizing TFSA and RRSP contributions because registered account investment returns are one of the few wealth-building mechanisms that does not depend on domestic productivity growth. Implication 4. The productivity crisis makes global diversification mandatory, not optional. A Canadian who holds 50 to 60% Canadian equities is concentrated in the lower productivity economy. XEQT's 25% Canadian allocation is already a meaningful overweight to Canada's 3% global market cap share. But it is a principled overweight based on currency matching. Moving beyond 35 to 40% Canadian concentration means betting on the specific companies in the lower productivity economy while missing the technology and healthcare sectors generating the most productivity-driven earnings growth globally. The productivity crisis is a structural, multi-decade, policy-level problem. Individual Canadians did not cause it and cannot solve it. But individual Canadians can respond to it in ways that meaningfully protect and improve their own financial position within the system as it exists. Response 1. Invest globally, not just domestically. The most direct investment response to the productivity crisis. XEQT or VEQT, with approximately 75% global allocation, ensures your investment portfolio is not concentrated in the lower productivity economy. Canadian stocks should be a principled overweight for currency matching purposes, approximately 25 to 35%, not a home bias overweight of 50 to 60%. The productivity data makes the case for global diversification more compellingly than any general diversification argument. Response 2. Build skills that are internationally portable. The brain drain is a signal. The Canadian workers leaving for the U.S. are leaving for a reason, and that reason is a combination of higher nominal pay and lower effective tax rates. For a Canadian who is considering their career trajectory, skills that are internationally portable and in high demand globally, technology, finance, healthcare, engineering, provide a personal hedge against the domestic productivity crisis. If Canadian wages remain constrained by low productivity, the ability to seek opportunities in higher productivity economies is a real option with a very high financial return. Response 3. Maximize TFSA and RRSP before everything else. When wage growth is constrained by low domestic productivity, the investment return inside a TFSA or RRSP becomes even more important relative to income. A 7% annual return on a $100,000 TFSA invested globally generates $7,000 in tax-free wealth, independent of whether the Canadian economy is growing at 0.5% or 2.5% per capita. The registered account system is the individual Canadian's best lever against the productivity crisis, because it captures global returns regardless of domestic economic performance. Response 4. Understand that the housing market is a symptom. Canada's housing affordability crisis, the most visible expression of economic dysfunction for most Canadians, is partly a productivity crisis symptom. Incomes have not kept pace with home prices, partly because productivity growth has not justified the wage growth that would make housing more affordable. Understanding this framing prevents the mistake of thinking housing affordability is purely a supply problem or purely a demand problem. It is also an income problem, and the income problem is a productivity problem. Response 5. Pay attention to policy changes that affect productivity. Interprovincial trade barrier reductions, investment incentives, R&D credits, immigration policy that targets skills gaps rather than volume. These policy changes have direct economic consequences for Canadian living standards and investment returns. The Canadian investor who understands the productivity crisis is better positioned to assess which policy changes are meaningful and which are cosmetic. The most important number most Canadians have never heard: $15,000. The annual income gap between where the average Canadian is and where they would be if Canada had simply matched U.S. productivity growth since 2000. Canada's GDP per capita fell 2.0% over 2020 to 2024, the worst five-year decline since the Great Depression. The OECD projects Canada will rank dead last among 38 wealthy nations in per capita growth through 2060. Canadian business productivity declined 0.6% from 2018 to 2023, while the U.S. grew 10.1%. 5 structural causes: underinvestment, interprovincial barriers, the innovation gap, the brain drain, and sector concentration have been compounding against Canadian living standards for decades. The mechanism is the same as compound interest, except it is working against you. For the individual Canadian investor, the response is clear. Invest globally through XEQT rather than concentrating in the lower productivity domestic economy. Build internationally portable skills as a personal wage hedge. Maximize TFSA and RRSP contributions because they generate global returns independent of domestic productivity performance. And understand that Canada's housing affordability crisis, wage stagnation, and the general sense of falling behind are not personal failures. They are the predictable outputs of a documented, multi-decade structural problem. Understanding the problem is the beginning of responding to it effectively. That is what this video was for.